Hi and welcome to a new show. It's Accelerating Your Wealth with myself, Rebecca Robertson, and this is Ask Becky Anything. Hi and welcome to Accelerating Your Wealth with your host, myself, Rebecca Robertson. I'm an independent financial advisor and wealth coach. I'm the director of Evolution Financial Planning, who is also our sponsor for today's show. Don't forget to like, subscribe, share and review this episode. With your help, we'll reach more people who can benefit from the show. If you're somebody that is not sure what to do with their finances, maybe you're working and you're not sure what to do with the bonuses you've got at work, or maybe you started a business and you've got profits and you're not sure what you should be doing to enable you to A, pay yourself more, or B, potentially retire earlier. Maybe you're somebody that's thinking about, do I overpay on the mortgage? You've received some inheritance. You've got lots of questions around your finances and what to do next. Then check out Evolution Financial Planning, who are regulated independent financial advisors and financial planners that can help you make some of those big decisions in life. And so I'm going to get on with the first question. And this one's a bit of an anonymous one. So I'm not going to say the name. I'm not playing anything out. I'm going to read out their question. Hi, I have a question for your podcast. As a high rate taxpayer, is it better to invest in your pension or pay off your mortgage or buy to let mortgage with spare cash? Great question. Always a great question, people. I love this. Okay, so the question is really for high rates taxpayers. And so this particular person hasn't told me if they're employed or self-employed or a limited company. And it can be different in terms of the pension equation as to how you answer that. So if you're a limited company, by paying into your pension, you can reduce your corporation tax. So it depends on what level of corporation tax you're paying, because over 50,000, the scale can go up and up and up now. Yes, we are being taxed more as business owners. If you are employed and you're earning over 100,000, for example, you start to lose between 100 and 125,000. You start to lose your personal allowance. So by paying into your pension, effectively you can get some of that personal allowance back. Also, if you have children and you're earning over 100,000, it means that you could potentially be losing out on additional benefits and childcare allowances. So by paying into your mortgage through work or through your limited company, it can effectively save you tax initially. Now, when it comes to the traditional question of do I save or do I invest or do I put in to pay off my mortgage, often interest rates are generally lower than the average rate of returns for a medium kind of risk client. So an example, and investments can go up or down. There's no guarantees of what the next 12 months or the next 12 years will look like, but a good average is usually around the 7-8% mark. When you do projections for pensions, a high rate of return under the FCA guidance is more like 5%. So if we were doing quite cautiously, because they're old, clients often older, you might take less risk, therefore less returns, you would maybe do a 5% return. So if your mortgage is 3 or 4% and you're not at a retirement point, which I wouldn't expect you to have a mortgage at retirement anyway, then I would be encouraging you to say, well, actually, you're better off over the compound effect of that interest being added over the long term. For most people, not for everyone, you do have to run the figures, because if you've got a very high interest rate mortgage, or you've got a mortgage that's maybe going to run into retirement, or you might be sort of paying quite a lot each month, and financially that's not a good thing for you. There can be other reasons why you need to overpay and draw that mortgage down. I often say to people, if you haven't got those complexities, then it's more of a case of invest first, make sure pension provisions, your projections cover the expected level of income that you would like in the future, and then start drawing down on the mortgage, then start paying off the mortgage, In regards to the buy-to-let question, I think it depends on the strategy when you build a property portfolio. So traditionally, what people would do years ago is they would take out an interest-only mortgage, and they would basically pay the interest and then live off the capital, live off the income. But if they're employed, for example, accidental landlord, and they're a high rate taxpayer, then they're paying 40% tax on most of the revenue, minus some allowances which can be deducted. But now that can't be the mortgage. So effectively, a lot of people, by the time they pay the mortgage, by the time they've paid expenses, maybe a letting agent, maybe fixing the boiler or fixing the kitchen or fixing the bathroom, whatever needs to be done, over a 3 or 4 year period, they're actually at a loss. So you're finding a lot of those sort of accidental landlords are selling properties. For those that are more strategic, that are actually planning to build a property portfolio, they have a plan for actually what they want this buy-to-let to do. So therefore, they clear the debt down so that it's actually an asset that's giving them an income later on. And the benefit of property is that you have the assumed annual growth plus the income that it's generating. So it is good from a diversity perspective to build those assets, but it comes back to strategy. If you're not going to clear the mortgage down, then effectively you'll be planning to sell it before the mortgage term finishes, which I don't know exactly now. I was a mortgage broker for many years, but you don't want to really be managing a property into your 80s. I see a lot of landlords doing that, and then they end up passing it on to their children anyway, or getting someone else to run it for them anyway, or they have to sell the property anyway because the mortgage has come to maturity, and therefore they no longer can get any mortgage into their 90s, because there's only a certain deadline before a lender will say you can only have the mortgage to your 70, 75, for example, 80, for example. So there needs to be a strategy in place. So I think it's more about what's your strategy than what it is whether you should pay the mortgage down. And it depends on those 3 or 4 factors and how that pulls into the whole plan. So that's where someone would come to us and ask your financial planner, these are my personal circumstances, this is the amount of the mortgages, this is when they mature, this is how old we are, this is our pension, this is our tax position, this is what our future plans are, this is when we want to retire, this is how much income we would need. And once you've built that clearer picture, you can build a roadmap. But a one-fit-all scenario doesn't really apply to that kind of a question. But I hope that gives you some food for thought and some things to consider. Obviously, I'm giving guidance here. I'm not giving regulated advice. So I hope that just gives you some ideas and some information to look into more detail. But thanks for the question. Did you know I wrote a book? It's called Accelerating Your Wealth. Funny enough, the same as the show, Accelerating Your Wealth podcast show. But this is 10 ways to accelerate your wealth. It was designed to really help people with their finances in a simple way. So we focus on some key sections around your money mindset, some practical things that can be done with your finances, and allowing you to maximize your money and your future. So if you're thinking, hey, this stuff is interesting, then the best next step for you is to check out the book. It's an Amazon 5-star bestseller. Yeah, I know, it's great, right? Go and check it out. You can buy it on Amazon and have it with you tomorrow for a nice cup of tea. Okay, next one. Now, this is a curveball, and I've never had this question before, and I almost could have a whole panel discussion about this subject alone. And I was debating whether to play it or not, because it does open up a can of worms, and I'm not going to be able to answer all of this question in one go, because it's actually like 3 professions that would be able to answer this, and I'm only one person. I do have quite a broad knowledge on lots of different subjects, but if this is an area that you want to learn more about, please comment, message, whatever platform you're listening to this on, subscribe, and let me know, and I will make sure that I will build in a panel discussion around this. So here we go.
Hi Rebecca, it's Katrina Young. I'd love this question answered. I am particularly interested in the strategic use of trusts for long-term wealth protection and intergenerational planning, especially for business owners and founders who are building assets across multiple entities. More specifically, protecting business equity and intellectual property, structuring income dividends tax efficiently, supporting succession planning and future exit scenarios, providing financial security for children or dependents, ring fencing assets from potential future risk or claims. It would be helpful to understand which type of trusts are typically most suitable in these scenarios and at what stage founders should consider planning them. Thanks so much.
Right? I feel like she's got some inside information on that question, just from the language that she's using. She's a very smart cookie cat. So it's an interesting one. So I can't really answer the question around business law or contractual law around that, but I can talk about trusts and how I see them being used. So I'm not an accountant, I'm not a contract business lawyer, and I'm not a solicitor writing estate plans. So that's like 3 other professions, and I'm the 4th, being a financial advisor. And the kinds of trusts that you have will depend on the asset. So typically, when you're talking about any kind of asset and it's owned by a business or it's owned by a person, you can gift that asset via a trust. So the word trust is very much well used. Technically, there's only about 3 or 4 actual trusts, and people put different words on them, either for marketing or for their own branding. So even with financial service providers that provide, for example, certain products, and you can put those products into trust, they have all these different kind of words of different connotations, but at the end of the day, they're all the same thing. They're a discretionary trust. So it's really having to understand not just what kind of trust it is, but how they interpret how that works. And the same applies for solicitors. So solicitors might use certain estate planning trusts, and they might call it a family probate trust, but at the end of the day, it's a standardised discretionary trust again. So you just have to be quite careful as to what kind of person, who you're talking to, and understand really what's under the bonnet and really what you're buying into. And it's being very clear on what you want the purpose to be. If you are to gift something via a trust, essentially, most of the time, you are saying, I no longer want access or need that money or that asset. There are some examples where there's flexibility because some of the trusts are becoming more flexible since pension reform changes, so that it gives them a degree of access, or some of them will give you income, but not necessarily access to the full lump sum asset. But by essentially, when you're gifting it into the trust, you're saying this is for a beneficiary, and that might be children. But you're still the beneficiary initially in some examples, and then on death, it passes on to the next person. So they're quite complicated because people have different names for them, different purposes for them. You can also have a trust in a will. So it's when you die. So the trust is not created until death. And by being in the will, that activates it. So that's usually a family property trust. And then you also have an estate plan, which is where the trust is actually set up now, normally with £10. And you normally do it via writing your will, but it's actually the trust is a separate thing, and actually is created now. But on death, it sort of activates the remaining transactions, and essentially people can put property that they live in into those trusts so that they can ensure that the assets are passed on to their beneficiaries in the correct way. Benefits of that can be concerned about children getting into debt or bankruptcy, divorcing, for example, making sure that the person that's left doesn't change their will. So first person dies, second person's still alive, they might rewrite their will. You have to be very careful with some of those, because you're also essentially taking the assets, in most of these examples, out of the estate. Therefore, it doesn't necessarily mitigate first inheritance tax rules, but it can, because some of the trusts don't work in that way, because depends on when the transaction happens in terms of the gifting. But it can mean that you've deprivated your assets for care fees. So again, you have to be quite careful that you're not just assuming that you're gifting this money away, gifting this asset away, but you're going to have potentially, in some examples, no access to it, no income to it. and you're potentially putting yourself in a position where you could be accused, depending on your age, but if you're older, where they're then being told that you've intentionally deprivated your assets, and that's usually the local council wanting you to prove to pay for your own care. That might not happen straight away, that might happen years later, in which case law and circumstances may have changed in that time. You can put life policies in trust. So when you set up a life policy, you can put that in trust. And that means that basically the asset goes to the beneficiary. There's no sort of gifting or worries around that. But it does sit outside of your estate for inheritance tax planning. And it does mean the beneficiary gets a cheque from the life provider who you insured the person with, rather than having to wait for probate, which can take sometimes 6 months or longer. So by doing those kinds of things, they can be quite quick wins. So that would so from Kat's question, it's quite hard to answer specifically in the way that she wants, because I'd almost need to have different opinions from several different people in terms of professionally how they would deal with it, because each possibly solicitor would word it differently. They have preferences on which legal way they would go about doing it based on their case knowledge, which cases have been questioned, which ones have gone to court, which ones haven't. And equally, business-wise, it depends on how the business has been set up, therefore how the asset can be accessed. So again, it's, contractual law is not my bag, so I won't answer something if I'm not confident on it. What I will say, what financial advisors can do is that we can help with some of the things that I have mentioned, where it is about looking at your overall financial position and considering which things could help you mitigate inheritance tax. But a lot of people shouldn't really be gifting at a young age when we don't know what's going to happen in terms of circumstances. So you want to make sure you're covering yourself first and you have your own provisions in place first before you start gifting away too much. So it's good to get advice on your personal finances first and then look at extending that out. If that's a subject that's interest to you, like I mentioned straight at the beginning, please comment, please let me know, and then I will arrange a further discussion, possibly with a panel interview instead of just little old me. I hope that's been helpful for today. Again, no advice has been given. This is general guidance and information for you to help and inform you to start making some of your own decisions. But if you are looking for regulated financial advice, do check out our sponsor, which is Evolution Financial Planning, www.evolutionfinancialplanning.co.uk, who are able to give you personalised, bespoke, independent advice based on your personal circumstances. Thanks very much. Thank you for joining us today at Accelerating Your Wealth with your host, myself, Rebecca Robertson. I hope you enjoyed the show. Do subscribe and let us know in the comments any of your thoughts.